As virtually everyone knows, if you're a long-term investor, the absolute must-own asset class is stocks. So many books by Warren Buffett, Jack Bogle, Jeremy Siegel, and others have driven home the point that stocks are unparalleled in generating long-term wealth. And I agree. So here's a question that's important to ponder, even though it's impossible to answer reliably. How long is your long-term time horizon really? I've put out articles and videos explaining that longevity risk is a wildly underestimated financial risk. In the coming generation, it's nearly certain that a shocking number of Canadians will still be alive but will have run out of money despite having done everything right. The one thing they did wrong, it seems, is to fail to die on time. Instead, they planned to die at an age like their parents lived to be, and then went on to live longer than they ever imagined they would, or even could. That concept alone means many people should have more money in stocks than they thought they should in their retirement years. A simple rule of thumb that I've used in the past is to take your age and to multiply it by a decimal of that age to get your percentage allocation to income, with the rest being in some form of equity. So a 30-year-old would have a 9% allocation to income, a 40-year-old would have a 16% allocation, a 50-year-old could have a 25% allocation. A 60-year-old could have a 36% allocation. A 70-year-old could have a 49% allocation. And then ironically, at age 71, where everyone has to convert their RSP to a RIF, that's the same age where the formula yields a 50-50 allocation. And lots of people would prefer to stop there, and I wouldn't blame them. However, let's just continue with the format for the sake of completeness. An 80-year-old would have a 64% allocation. A 90-year-old would have a 91% allocation to income, and a centenarian would have a 100% allocation in bonds. The question that this begs is it possible that this approach allocates too much money into stocks for retirees? The answer to that question may well rest on the question I asked at the outset. How long is your long-term time horizon really? Despite what we've just walked through, it's my view that many retirees are nonetheless overexposed to equity risk in 2026. Allow me to explain. While risk and return are related, risk is not constant. A lot of how risky markets are depends on how expensive they are. And if they're trading at a low multiple, so for instance at a price-earnings ratio of 14 or something, then there's a margin of safety that's tied to the circumstance of the day that should give investors confidence that they can indeed employ a long-term outlook. My preferred metric for risk is Professor Robert Shiller's CAPE reading. CAPE stands for Cyclically Adjusted Price Earnings. Shiller is an internationally recognized economist and an influential thought leader. He has frequently pointed out that while CAPE is very good at quantifying risk, it is nonetheless poor at market timing. Indeed, while the current reading on the S&P 500 shows a CAPE reading of about 42, which is the second highest it's ever been, and it's only a tad lower than it was just before the dot-com bubble burst, the stock market is therefore expensive. And therefore, it's risky. Given what we know, how should older investors proceed? On one hand, they're likely to live a long time still. But on the other, markets are nearly as risky as they've ever been. And at this point, I think a history lesson is in order. At the end of 1989, the Japanese large cap market, the Nikkei 225, was trading at an all-time high. And when the new year arrived, the Japanese market began to drop. Although the drop was not in a straight line, it wasn't until 2 years ago that the index beat the highs established in 1989. That's way over 30 years of being underwater. If you were a 60-year-old with a 64% allocation to stocks and a 36% allocation to bonds at the end of 1989, you would have likely started drawing down on your principal within a decade after the markets began to drop, and then you would have continued to draw on that pool of capital for another 20 years afterward. Granted, the Japanese example is extreme in modern times, and the current American stock market, while unambiguously expensive, is still cheap compared to the Nikkei in 1989. I strongly question whether a drop of such severe and sustained magnitude is even possible in the US right now. But what if it spilled over to Canada and was merely half as severe and lasted half as long? If you were already retired and the market were to drop now and take until the 2040s to hit new highs, how would you fare financially and psychologically? I ask for both tests because regulators require that portfolios be constructed while considering both risk tolerance and risk capacity. they should also be constructed to not exceed the threshold of what can be tolerated for the more conservative of the two tests. So my concern is for people who are retiring and converting their RSP to a RIF at age 71. If they have a 50-50 allocation, half their portfolio could be underwater for a decade and a half. My view is that most retirees simply do not have both the tolerance and the capacity to handle that kind of news. These are challenging times. On one hand, many of us know we're likely to live a long time still. On the other, we also know that equity valuations are frighteningly high. There's no obviously correct take. No one knows what markets will do, and no one knows when their time on this earth will be up. The best we can do is to make better wealth decisions by taking in as much information as we can, filtering it through our values and circumstances, and hope that we're not extremely unlucky.